We got some massive news for all stock market investors as the central bank chairman Jerome Powell indicated that there will be more interest rate cuts coming by the end of this year. This increases the likelihood of interest rate cuts. Just a month ago, the market was expecting only 2 interest rate cuts this year. Now it looks like the number of interest rate cuts has increased. And actually, I think these interest rate cuts might be larger than what the market is expecting. Maybe the number of cuts might be the same, but they won't all necessarily be 25 basis point cuts. There might be a bigger cut coming, and I'm going to talk about why that could be the case here. Let's jump right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Right, so the sharp slowdown in hiring poses a growing risk to the U.S. economy, Federal Reserve Chair Jerome Powell said on Tuesday, a sign that the Fed will likely cut its key interest rate twice more this year after already cutting once. And the market right now expects these two more cuts to be 25 basis point cuts. I think there is a probability that one or more of these cuts could be larger than 25 basis points. The Federal Reserve Chairman here, you have to look at these words and the adjectives that he uses very carefully because they have great indications about what the central bank policy could be. And note here how he's saying a sharp slowdown in hiring. It's not just a slowdown in hiring in the U.S. economy. It's been a sharp slowdown in hiring in the U.S. economy. Powell said in written remarks that despite the federal government shutdown cutting off official economic data, the outlook for employment and inflation does not appear to have changed much since our September meeting when the Fed reduced its key rate for the first time this year. So what that means is even though the central bank cut interest rates about a month ago, that interest rate cut hasn't resulted in an increase in economic activity. And that's not surprising because interest rates cuts take time to work their way through the system. There's a lag. Typically, there's a lag between 1 to 2 years. And some market participants have suggested that the lag between the interest rate cut and the resulting economic impact has shrunk because nowadays the announcement of an interest rate cut works its way through financial conditions relatively quickly as investors anticipate the interest rate cuts coming and they make financial decisions in anticipation of the incoming interest rate cuts. That might be true to some degree, but there is real economic activity that lags behind the interest rate cuts. For instance, the interest rate cuts only start to have an impact on car loans and mortgage rates. And those interest rate cuts, when they start to lower the amount of interest rate or the monthly payment that consumers pay to purchase for cars, for homes, they then start to make decisions based on that change in interest rate because it changes the monthly payment, right? So let's say if you're an individual and your lease on your apartment is coming due at the end of December 2025, and you're looking at mortgage rates closely because you're trying to decide when your lease is up, do you renew your lease or do you look for a new home to buy, or do you look to buy a home instead of renting an apartment again? And these changes in interest rate policy will have an impact on your decision because if you're going out and shopping for mortgage rates and your lender tells you, "Oh, great news, mortgage rates have fallen by half a percentage point or 1 percentage point, and that means you can afford more of a house or you can afford that house that you were looking to buy," that's going to change your decision. That's going to make you more likely to purchase the home versus renting an apartment. And if you purchase the home, that means an increase in economic activity, right? Because if you purchase a home, you might hire movers, you might want to update the bathrooms in the home that you're purchasing, you might want to buy new furniture. The lender that's working with you will earn a commission for providing you with that loan. The Real estate agents working on the sale will earn a commission for selling that home. They will then go out and spend the money that they earn on those commissions, and that positive virtuous cycle works its way through the economy. But as you can imagine, that takes time, right? It's going to take time for you to see the lower mortgage rate, make the decision that you want to buy a house, go shopping for a house, find the house you want to buy, ultimately make a bid for the house, get the contract approved, the sale approved, the 30-day escrow process, and on, right? So that's why there's a lag between when central banks cut interest rates and the responding positive economic activity as a result of lower interest rates. So it's not surprising that even though the Fed cut their interest rates last month, that we haven't really seen a positive economic impact on the economy. We haven't seen an increase in hiring. In fact, hiring has slowed down considerably. The data points that I'm seeing shows that hiring has slowed down considerably, and the central bank now indicating that they will continue and they might cut interest rates more, and they might cut interest rates more sharply, so that by the time the economic activity from these initial cuts starts to work its way through the economy and the slowdown of hiring continues, those positive developments from the early interest rate cuts can help lift the economy and prevent it from going into a recession. And the recession is what stock market investors are concerned about. I have data here going all the way back before 1950 from fred.stlouis.org, and this is the unemployment rate going all the way back to 1950s. So what you can see here in the most recent times, since 2023, the unemployment rate bottomed at around 3.4%, 3.5%, and started increasing since then. And now what you have is an unemployment rate that's above or around 4.3%. And I wouldn't be surprised when the Labor Department, following the government's shutdown, when it actually reports the most recent labor data, that we will see perhaps unemployment rates ticking higher. Now, it has the unemployment rate, the way it's calculated, sometimes even though there's poor job growth, the unemployment rate doesn't increase, because the unemployment rate measures the labor force participation rate, which includes people that are looking for work. So people that have been discouraged and stopped looking for work, they're not counted in the labor market, so they don't work against the unemployment rate. Furthermore, there's been an increase in immigration enforcement and the population decline, and the decline in those individuals creates a decrease in the labor supply, which could then stop the or decrease the impacts on the unemployment rate, because you don't have as many individuals looking for work. But what you can see here, going back all the way to 1950, is once the unemployment rate starts to increase, we usually have a recession that follows the increasing unemployment rate. You can see that back here in 2007 when we started to have the increase in unemployment. These gray shaded areas indicate a recession, and unemployment rates surged. And same thing when the 2020 pandemic, there was a recession, but it's kind of an outlier, so we won't talk too much about that. Then you have the 2000, the dot-com bubble, and you had the unemployment rate increasing, then you had a recession. 1990, you had the unemployment rate increasing, then you had a recession. 1980, 1979, 1972, 1969. All of these indicate that when the unemployment rate starts to increase, it goes into this negative virtuous cycle that leads to a recession. And you can understand why that happens, right? So once the unemployment rate starts increasing, that's fewer people going out and buying cars and going out to eat, which then causes businesses to slow down hiring even more because there are fewer people buying their products. And that causes a further slowdown in economic activity and a further decrease in hiring. And on you go. until you reach a point where the economy has slowed down so considerably that entrepreneurs start to see opportunities in areas and start to make investments to capitalize on these lower prices, on these people that are now available for work, and you can hire people that are not demanding as much in wages as they were before the economic recession. And then you also have offsetting forces from fiscal policy, the government spending more money during recessions. Usually always happens when there's a recession, the government will come in and do some kind of spending program to lift the economy. And then there's the automatic stabilizers like unemployment insurance that offset some of the declines. So the risks of a recession are certainly increasing. Central Bank Chairman Jerome Powell reacting to those increasing risks to decrease interest rates. This is now taking more importance compared to inflation, where inflation was the bigger problem, the bigger concern, the bigger risk for the better part of the previous few years. Now, economic recession and a slowdown in unemployment has become the more important factor, the bigger risks to consider. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.